Hi and welcome to my video. My name's Anthony. In this video we're going to cover a potential upcoming liquidity injection by the Fed. On the surface we have the Fed's public promise. They tell us they're strictly committed to fighting inflation, keeping things tight and controlled. But when we look away from the press conferences and actually study the charts, a hidden truth starts to emerge. The data is telling a completely different story. Instead of tightening, the signals suggest a massive liquidity injection is actually on the horizon. We call this the everything code, and to understand where the market is going next, you have to understand how it works. So let's take a look behind the curtain. We're going to break this down into 4 key chapters. First, we need to decode the hawkish cut and make sense of the mixed signals we're getting from the Fed. Second, we'll uncover the hidden force, a debt wall of historic proportions that simply can't be ignored. That leads us directly to the everything code, the undeniable link between money supply and asset prices. And finally, we'll talk about the inevitable flood and what the future actually holds for global liquidity. This brings us to the concept of the hawkish cut. It sounds like a contradiction, doesn't it? On paper, the Fed did cut rates again, 25 basis points, bringing the funds rate down to the 3.5% range. But if you look closer, this wasn't a unified decision. We saw historic internal division, with the most dissenting votes we've seen since 2019. Essentially, Powell is walking a tightrope. He gave the market a cut, but he's signaling that the easy work is done and future cuts are going to be much tougher to justify. You see, despite the tough talk, the market just isn't buying it. Traders are already pricing in 2 or more rate cuts for next year. Why the disconnect? Well, everyone knows the clock is ticking. Jerome Powell's term ends in May 2026, and the frontrunner to replace him is Kevin Hassett, a known inflation dove. This creates a fascinating dynamic we call the shadow chair. Essentially, Powell's influence is fading because the market is already looking past him, placing its bets on the looser policies of the man likely to take his seat. But the shadow chair is only part of the equation. The real story, the physical constraint forcing the Fed's hand, is this massive wall of debt. We are staring down a refinancing challenge of historic proportions. In 2025 alone, $9.2 trillion in Treasury debt matures. That debt doesn't just disappear, it has to be rolled over. Then, in 2026, up to another $9 trillion comes due. That means in just the next 24 months, the system has to handle refinancing nearly $18 trillion. That is a tsunami of supply that the market has to absorb. And that refinancing problem leads us straight into what we call the fiscal dominance trap. It's a vicious cycle. We have all this old debt that was issued when interest rates were near zero. Now, as that debt matures, it has to be refinanced at today's much higher rates. That leads to higher interest payments, projected to top $1 trillion in 2026 alone. That's more than our entire defense budget. Those higher payments drive a bigger deficit, which requires more borrowing, which keeps rates high, and the spiral just keeps spinning. And this dynamic creates the perfect environment for what we call the everything code. It's a simple but powerful theory. Liquidity is king. When the global money supply expands, asset prices follow. Just look at this chart. We are seeing a 0.94 long-term correlation between global M2, that is all the cash in the world economy, and the price of Bitcoin. The math is straightforward. When the money supply expands, scarce assets tend to rise. But this isn't just a US story. The global liquidity tide is already turning. Just look at China. They've already injected the equivalent of about $1.5 trillion in just 6 months. And even here in the US, despite the Fed's tough talk, M2 money supply is quietly growing again at 4.6% year over year. We are entering a period of synchronized global easing, where major economies are opening the taps at the same time. So how do they stop that spiral? What happens if the market refuses to buy US debt at the low rates the government needs? That brings us to the nuclear option, yield curve control, or YCC. Basically, the Fed steps in and buys unlimited amounts of government debt to artificially cap interest rates. Think of it as quantitative easing on steroids. It protects the government from defaulting, sure, but make no mistake, it is pure money printing. All of these forces are converging into a perfect storm for liquidity in 2026. You have a massive $18 trillion debt wall that needs refinancing. You have global money supply already expanding. You have huge fiscal demands from election year dynamics requiring low rates. And on top of that, you have an internally divided Fed that will soon likely be led by a dove. It is the ultimate setup for a flood of new money. So, here is the inevitable conclusion. The Fed can talk tough all they want, but they are constrained by the hard reality of US debt. Refinancing up to $18 trillion at today's high rates is simply fiscally impossible. Faced with the choice between defaulting or inflating the debt away, the government will likely choose inflation over default. That points to one outcome: a major liquidity expansion, which acts as a massive tailwind for scarce assets. So the bottom line is this: the liquidity is coming. Now, it's important to manage expectations because there is typically a lag, about 2 to 3 months, between when the liquidity taps open and when asset prices actually react. The long-term trajectory for scarce assets appears clear, but don't be surprised by some short-term volatility. Ultimately, the direction of the market is being driven by debt, and in this environment, patience will be key. And that pretty much wraps up this presentation. If you've gained any value from this, I would be incredibly grateful if you were to support my channel with a thumbs up. If you want more content, subscribe and hit the bell, as I'm going to be uploading regular videos like this. With that, I hope you have a fantastic day. See you in the next one.